Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, Ryan Bolton here. I am a mortgage nerd with Patriot Home Mortgage in St. George, Utah. I thought it'd be fun today to go over abbreviations. Our industry is notorious for having abbreviations for just about everything. I think maybe the military, maybe medical might have more, but I'd love to put the abbreviations of our industry against any other industry because they are crazy. We even have abbreviations that are abbreviations of abbreviations. Yeah. Imagine that. We actually had two words that were already abbreviated, smashed together to create a whole new abbreviation that is it's really fun. So I thought today we would do mortgage abbreviations, and it's fun because some of them you say, like the FBI, you don't say FBI, you say the letters, where other times you actually say what it says. So I think we'll go through some of these abbreviations, have a little fun of what they are and why we need them and what they mean. So that way, as you're out there trying to buy a house and somebody accidentally uses an abbreviation, industry jargon. I think the other day I had a client, I just said, hey, the MBS is up or down. And they're like, what's the MBS? And I'm like, oh, well, duh. It just kind of naturally came out. I'm like, well, that's mortgage-backed security market. That's what determines interest rates. So we'll go through a couple of these. I'm going to see if our producer here, Freddie Mac, knows what these could be as well. I mean, he's in an audio-visual space. So I wonder if any of these have some overlap. Because sometimes I'll Google abbreviations, you'll see all these different variations of abbreviations. So it's kind of fun. So let's go. Slide number 1 is our topic, I believe, mortgage abbreviations. Again, my name is Ryan Bolton. I'm with Patriot Home Mortgage. I lend in the states of Utah and Nevada. Love to earn your business. If you're looking to buy, refinance, home equity loan, we do all kinds of fun stuff. So check out my website, ryanbolt.com. So let's go to our first abbreviation. All right. Mr. Freddie Mac, what is LTV?
I know what TV is.
You know TV. Okay. All right.
So, leasing television. No. Lending television.
Okay. All right. You're at least trying to hit the...
Lenders to Vulcan. I don't know.
So LTV is loan to value. This is a major determiner of what you get. There you go.
My wife and I were talking about that over breakfast this morning. My bad.
No way. So loan to value is what we determine the loan amount is versus the value or the sales price of the property. So loan to value is a real big factor because certain programs only go to 80% LTV or loan to value. And every loan to value that we see is typically on 5% increments. So there's no benefit to, say, putting 12% down or 22% down. They're all always on 5% increments. Now, FHA starts off with 3.5% down, kind of a unique little feature, but most loans after that are going to be 5%, 10%, 15%, 20%, and so on and so forth. So loan to value is one of the key things that we're going to ask on what we're doing as far as down payment, how much money we're working with. And that's where I often tell my clients, if they have just a dollar amount, I have got 15 grand, I've got 20 grand, I got 40 grand or whatever to put down, I'll take a look at the loan to value and say, well, you're getting the same rate by putting $32,000 down than 40, so that 8 grand can be used to pay off other debts or just save it, or doesn't really make a benefit to the loan to put that extra money down. One other thing with loan to value is they go off the appraised value or sales price, whichever is less. So for instance, let's say we have a $400,000 home that you're buying, but it appraises at $450,000. That doesn't mean the loan gets to use that $50,000 difference. We go off the lesser of the two. Now, reverse can happen. Let's say you're buying it for $450,000, but it's only worth $4,000. You have to bring in that $50,000 plus the down payment to get the loan to value at, say, 95%. So there's times where people actually end up having to put more money down. It's more rare. Usually they're buying it for appraised value, but we've seen times where if the home's very custom or there's a lot of features with it that make it more expensive but doesn't necessarily appraise for that, you'll see that with pools. You'll see pools that are $100,000 pools that really don't add $100,000 worth of value. So that's one of the factors that we look at. But whenever you're looking at a down payment or a sales price, go in 5% increments. Again, there's no reason to put 12% down or 7% down. You're usually better off to stay at the 5% number. All right. Oh, I think the next slide actually says what that LTV is. Aha, loan to value revealed. All right, let's see what our next acronym is. Ooh, all right. What do you think?
Australia. I know that one.
Oh, yeah.
Right?
I've seen that too with like currency and stuff. I'll see in AUS every once in a while. Like, oh, okay. So, okay, Australia. Nope. Any other guesses?
No.
Okay. This is AUS, so we don't say AS, I guess. It's AUS. This is, and go to the next slide. This is automated underwriting system. So Freddie Mac and Fannie Mae have a automated underwriter, meaning that once you have the application, it goes into their computer program with a whole bunch of algorithms and starts checking debt ratio and time on the job and all the risk of that application. So almost every loan, whether it's Fannie, Freddie, FHA, VA, almost every single loan on the planet now is run through an AUS system, an automated underwriter. You have Loan Prospector, or LP, another abbreviation, or you have DU, which is Desktop Underwriter for either Fannie or Freddie. That's why I call our producer Freddie Mac. Might not even known that. So he's LP, everybody, which is like OG. What's an LP? That would be like OG.
LPP, yeah, you know me. I don't know.
There you go. So Fannie and Freddie have these systems that have become so universal to at least check things, and it gives you a finding after it reviews that application. Now, of course, the application you can put, I make $10 million a month. If you don't make it, you have to rerun the automated underwriter with the numbers that are accurate to the application. So an actual physical underwriter's job is to check the findings or check the application and see if it matches the actual documentation. But this first step allows an underwriter to know, is it even worth it? It checks a lot of things they don't have to recheck. It kind of automates as much as possible, and they're getting more and more and more sophisticated. They're even getting to the point where appraisals get waived because it can check and say, okay, yeah, that value is reasonable. We have enough data. We can pull enough other reports. We can pull other areas. We can see that the value you put in there is satisfactory. Now, you see appraisal waivers a little more in other states. Utah's a non-disclosure state, so there's not as much public data on appraisals, and you don't see them on purchases as often. You see them on refinances, or if you got somebody that's been in the house for 10 years, they can see the tax assessed value is way more than what they're loaning. They can say that it's worth the risk not to do an appraisal. So AUSs are designed to give kind of an underwriter a head start, so they don't have to review every single part of the file, and just know it's even worth submitting the file. If you don't get an LP or DU accept, then you know right off the bat you don't have a loan yet. You've got to go in there, either add assets, fix the credit. It'll tell you kind of why it doesn't like it in most cases. So you can go back and see, oh, I just entered it wrong, or I just need to fix that, or I need to change it. But there's a lot of times that this gets run on every single file, whether you're going to do in a Freddie or Fannie or Freddie loan. These automated underwriters, these AUSs, get run on just about every mortgage done in America. So there you go, AUS. So if you're a real estate agent, ask your pre-approval letters from your other lenders. Obviously, if you use me, you're going to get this right off the bat. But if you're an agent listening to this, ask the pre-approval, have you run AUS? And I guarantee you, most loan officers are going to go, whoa, they know what that term is. Like, most agents never ask. They just call up and say, hey, is he really approved? And you say yes or no, or yeah, this is what the file is. But if you actually ask them, what is the findings? Have you run AUS? You're going to know that they've gone far enough to run that they're a little more professional, that they've actually run that first step on their pre-approval. If they haven't, that pre-approval may not be quite as strong. And you'll say, well, why haven't you run it? Or run it. What's the findings on it? And so it's a little tip out there. So whenever you see a pre-approval letter from another lender, ask them if they've actually run AUS. All right, let's run on to the next slide here. What do we got? And there we go. Aha. Freddie Mac, what do you think?
Equal Credit Opportunity Act.
Hey! How do you say the acronym, though?
ECOA.
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 Yeah.
So close.
So, yeah, there's some that you don't say the word like it's spelled, like transliteration or however the word is when you actually just combine the words and make a new word out of it.
ECOA?
ECOA. That's
like Ebola.
Yeah. Yep.
Okay, it's probably a bad combination there. My bad.
I mean, it's not wrong. It's just you. That's why we call him Freddie Mac, everybody. So ECOA is the equal. Go to the next slide. This is what it stands for. The Equal Credit Opportunity Act. So this was an act that allowed that prohibited lenders that offer credit to discriminate on protected classes, to make sure that they were offering equal credit to everyone, regardless of race or national origin or gender or all kinds of stuff. Now, those things are being talked about of what are some of these protected classes, because you have other things in the mortgage industry that are also protected. There's another acronym called HMDA that is housing discrimination. So on top of actual credit discrimination. But ECOA has gone through some revisions. We actually have a guest that's coming on about credit repair and credit. So we'll get into a lot of this with ECOA. But ECOA is the opportunity that you can't be discriminated. Now, age can still be a discrimination because you have to be old enough to sign the contract. So there still is some provisions there that as long as you're old enough to sign the contract, there can't be a discrimination. So there is sometimes in those discrimination laws where there is an opportunity to say, well, he's only 14. He can't sign a mortgage yet, that type of thing. But we can't discriminate against someone that say is 90 on a 30-year mortgage. That's something that is protected at that point. But a lot of it has to do with race. That was the biggest reason for ECOA. Just making sure somebody wasn't getting excluded because of their race, their national origin, or their gender from even getting a mortgage, and any other type of credit. So ECOA doesn't just handle mortgage industry. It's anything where there's financing or credit. So you'll see it with cars. You'll see other things like that. There's also be disclosures about that when it comes to ECOA. So there's a good acronym for everybody. ECOA. What's our next one? Oh, okay.
Fosbo. So is this an acronym with the name, or is it just the letters?
No, it's actually each one of them stands for something.
Well, what I mean is, how do you say? Do you say FSBO?
Nope. This is not. This is another one that's not, and it's not. It's kind of funny. It's FSBOs.
FSBO. Okay, so it's FSBO. So
Yeah.
it's a word,
Right.
FSBO.
Yep. FSBO.
For sale by owner.
Yes, this is a for sale by owner. So this is where it's not listed with an agent. This is just where it is. We can go to the next slide that I think actually says for sale by owner. And this is where you don't have an agent involved, where you have it just being on the market with the for sale sign out front. They might even say for sale by owner, like you see on a car or something like that, where it's just for sale by owner. So the industry and a lot of its agents, you'll see they're talking, hey, this is a FSBO. And it's like, FSBO? FIZZBOW? FSBO? But it's just an acronym that a lot of us have used, and it's one that's very common. And it's another one of those that I think it's funny that that's said instead of FSBO. But this is anytime it's a for sale by owner. So you can get a mortgage on a for sale by owner. You don't have to use agents. You can even use your buyer's agent to help you with somebody that's selling a property. You just have to work on how the commissions are paid, or they're built in, or you pay them separately. But there's a lot of those. And actually, we're seeing that the market used to be about 50-50, where there would be 50% for sale by owners, and the other 50% would be listed by agents. And that has really changed. There's been a lot more that are sold by agents, but there's still a big FSBO market. There's still a lot of people who will just sell it on their own, put the sign out front. Or you'll see times where it's a family member that's buying it. So maybe the kids are buying the house from the estate, or there's family involved and stuff like that, where they're not needing an agent. They just need to get it worked out. So if you're in that situation where you're looking for help to get financed, where you don't have to use an agent because you've already got a buyer, I can help you with that. Now, legally, I can't help you negotiate on the price. That's where you have to have a real estate license when you're representing either a buyer or a seller. But as far as filling out the forms, you've already come up with a price. I can at least help you get the loan put in place. And a lot of times on these for sale by owner, especially to family members, there's ways you can structure it to help the person with down payment or using the loan to value in your favor. So for instance, let's say that you need to sell the house for $300,000, but it's worth more. You don't want to set the sales price at $300,000 for your family member. You want to set it closer to that actual appraised value. Then you can gift the difference. So they don't have to come up with a down payment. They don't have to have mortgage insurance. So there's ways to structure that. So if you are a seller of a home to a family member, it's worth having a conversation of how you structure that contract to just maximize the best loan for your family member. That way you aren't leaving money on the table. Or I had one that they only needed $90,000. That's all they wanted for the house. It was worth like $350,000. So they set the price at $90,000. That client had to bring money in. He's got $200,000 sitting there as equity once he owns the home, but until then on a purchase, it goes off the sales price. So there's just a right way to structure that contract. And if you're not working with agents or not working with a lender, you may miss out on being able to tap into some of those if you are in that scenario. It's not very common, but it definitely happens a lot, where you have maybe the mom and dad pass away, you've got 4 kids, and one of them wants to buy it from the estate or from the kids or from the trust. There's ways to structure that to just maximize the loan and just minimize undue expenses. Like the guy had to do mortgage insurance. He had a $90,000 loan. The house was worth $3,000, and yet he had to add mortgage insurance because of the way it got structured. So there's just right ways to do that. If you need help, I'd love to help you with that. All right, let's jump on to the next slide. Aha, this one's a fairly common one, I hope. What do you think, Freddie?
Price, market, I have no idea. PMI. I've heard of this term more than some of the others. PMI.
I think when you just said PMI, I think it hit your head. When you read it, you're like, oh wait, I know I've heard that term.
Yeah.
PMI is something we actually kind of talked about on the last one about needing it. PMI is private mortgage insurance. So whenever you don't put 20% down, for the longest time for mortgage financing for decades, you had to put enough money down to lower the risk enough to where you could still get the loan. So without private money or private mortgage insurance, many loans would not go over 80% financing. So you had to put 20% down. So since they came up with this insurance that protects the lender, so it's not an insurance like car insurance or homeowner's insurance or flood insurance or earthquake. There's so many insurances out there. But with private mortgage insurance, it's covering that if you default, don't make your payment, the lender has to foreclose. And if there isn't that cushion, they usually can't sell it for enough to get their money back if they're loaning 90 or 95% of what the home's worth. So this insurance is kind of a necessary evil, but it's opened the door where financing wouldn't even be available without that padded insurance. So FHA is really a mortgage insurance company. They don't actually loan the money. They're just setting the guidelines that if you follow those guidelines, they have an insurance fund to protect the lender, that if you're higher risk because of credit score, down payment, whatever it might be, that they'll step in and say, okay, our fund will cover the losses. So mortgage insurance is something you can remove after you have that 20% equity, or you put 20% down, you don't need it. But there's actually programs where you can pay a one-time fee instead of a monthly fee to remove that monthly mortgage insurance. This is a great option. So instead of tying up, say, 20%, you can put the 5% down, pay the fee, and the mortgage insurance is gone for the life of the loan. The fee can range anywhere between, I've seen 1 on the very low end, 1% of the loan, up to 4% on the high end. But a lot of times that one-time fee is better than having that mortgage insurance payment every month for the next 5 years. So it's worth knowing that that even exists to run the math and say, hey, is it better to get rid of this mortgage insurance? I've had times where the debt ratio is really tight. And I'm like, okay, instead of putting all the money down, let's back off the money, pay off some other debt, remove that monthly mortgage insurance, and now your payment's lower, so you either can afford more home or even get qualified on the one you're looking at. That's part of my job, is to get creative and say, okay, what do we have to work with here? How much money down? What interest rates are we dealing with? Is it better to buy down the rate or get rid of the mortgage insurance or both? There's even times where you can pay down the mortgage insurance. So instead of buying it out completely, you can pay maybe 1% or 2%, lower it enough to where the monthly mortgage insurance is down to $50 or something like that. So it's worth having that conversation and working with an expert that knows these things even exist to be able to maximize your buying power. Because right now, getting that dollar to stretch as far as possible can really help you afford the homes and get into a home now instead of waiting until the rates drop or waiting until prices crash or something like that, which it may never crash. It's just better to get in now with these options and these tools than to try to time the market just perfectly, especially if rates drop. Demand's going to go up like crazy, which isn't going to lower the prices. Everybody's saying, well, I'm going to wait for rates to drop and the houses to crash. Well, both things aren't going to happen. If rates drop, prices are going to go up. The demand's going to go up. Supply's not going to catch up as quick. And suddenly the prices are more. Even if the rates do drop, you're spending more. I still think it's better to get in, buy it, be comfortable, figure out a way to maximize that budget. If it's $2,500 a month, get rid of the mortgage insurance. Or get rid of the $500 car payment so you can afford the $2,500 with the same amount of money. So anyway, got a little soapboxy on that one. My goodness. All right. Well, do we have any more? I can't remember if we do. All right. Here's a fun one.
Heckham?
Oh, wow. That's really close.
Heckham?
Heckham.
Heckham.
Sickum Heckham. Wasn't there like a comic or something that was like that? Like, get 'em, sickum, heckham? No? All right. Gen Xers might be able to help me with this. All right, so this is Heckham. Get 'em, Heckham. Sickum. It's a dog term. No, so we'll go to the next slide here. This one is the home equity conversion mortgage. Do you have any idea what that is now? That's what it is, but do you know what it is?
So where do you take the money that's in your equity and then you get another mortgage on it?
No.
No, not even close. I have no idea.
So this is the official, more up-to-date term for a reverse mortgage. So they're called HECMs, or home equity conversion mortgage. So when FHA kind of took over or really kind of revamped the reverse mortgage program, Ronald Reagan kind of introduced this program, introduced this concept, and it just wasn't well regulated and it was just kind of emerging. and there just was a lot of abuses with it and just wasn't regulated well enough to be able to make sense for everybody. So FHA kind of brought this program under their umbrella. And just like when subprime loans were around, they changed the name. They're still around. They're just now called something different. They're now called non-QM or non-qualified mortgages. They kind of did the same thing. Reverse mortgages had a long reputation of just not being a very smart loan. Like people were very scared of. There's a lot of horror stories on a program that really had really good intentions, like most of the government programs. But it was something where they kind of revamped it. And part of that revamp was to actually call it something and just pull it under their coding and pull it under what it actually is. So a HECM is the actual term for a reverse mortgage. So a reverse mortgage is for those that are 62 and older that have equity in their home, and they use the equity, they convert it to make the payments. So instead of having to make a monthly payment anymore, the equity starts making the payment. So yes, the balance goes up. So if you only owe, maybe it's even free and clear. You don't have to have a home free and clear to do a HECM or a reverse mortgage, but maybe you owe a small balance. So instead of having the balance slowly go down with payments, the balance slowly goes up as the equity makes that interest payment instead. And the idea is to just help seniors stay in their home by getting rid of that expense, because a lot of them will have a ton of equity. You know, they only owe, maybe it's free and clear, and they got this $400,000, $500,000, $600,000 house right there where they're living off of $1,000 of Social Security, and they have all this equity they can't do a loan on because they can't qualify to make a payment. So this program is designed to help them stay in their home, convert some of that cash or that equity that's heavy into some cash they can actually use. And it's a really good program. I think most people, there's a lot of benefits to a reverse mortgage. I think at times it can be oversold a little bit. There has been some changes to it that lower how much they actually loan. But I tell you what, some of the best success stories I've seen, we had a guest on a few episodes ago. It really is a smart loan if you just know how it works and that you do know the balance goes up. Where I see people get problems with it is they'll use it to purchase the home and they'll buy a way more expensive home than they really need. And the property tax and insurance are still due. And that's where you see them struggle to kind of make that really big tax insurance payment. Where if they just kind of stick within their means and what works, they can still have something that's very affordable with the taxes and insurance. So HECM, another one of the ones where you don't say HECM, we say HECM. It's kind of a fun abbreviation that you may have seen floating around out there. So
I thought it was just a Utah thing to say HECM.
Go get them, HECM, SICM. I swear there's something with like HECM. I don't know. I have a really good friend. A little shout out to Nina Heck. Everybody in Southern Utah might know Nina Heck. She had a marketing company that was called Oh My Heck Marketing. I thought that was just, I think she still runs that. She does, she's awesome. Everybody that knows Nina, she's one of my adopted mothers, so to speak. So, I mean, I love Nina. She's awesome. Been a good friend ever since I moved to St. George and knows everybody. She runs one of the Facebook pages.
That's right. She runs, what is it?
St. George Word of Mouth.
Oh my gosh. I spent so much time on there.
I know. I see your post all there. And I think she has a family member that does a lot of the admin on that, but I think she's kind of one of the owners, but I don't think she does it every single, like hands-on every single day. I mean, she wouldn't be able to do that and everything else, but I think she's still one of the creators and owner, you know, I don't know, one of the big admins, but I think she actually has somebody full-time that has to check and screen and take posts down or warn them and stuff like that. And that becomes a whole other topic on that Facebook page. But and there's a couple other, like the real St. George word of mouth. But she's always been, I mean, she's really big on networking. I mean, she was big on the chamber. I mean, she's really out there. But I love, you know, Oh My Heck Marketing. What a great, especially for Utah. Oh My Heck Marketing. So I thought this was fun. There's abbreviations in our industry. I mean, we scratched the surface. I mean, there's so many abbreviations in the mortgage industry.
Okay, can you give me like a sentence that's just abbreviations? If you were to string like 5 or 8 or 10 of them together in a sentence.
Well, the CFPB said my IRLA was out of TRID because of ATR and APR. That might be close.
Let me get my Ovaltine decoder ring.
HUD and FHA, VA, USDA. I mean, they're all abbreviations too. But something like that. CFPB would have been a good one. The Consumer Finance Protection Bureau. That's one of the bureaus that governs our industry. They actually won a big loss. They actually had a Supreme Court ruling. So that might actually be, somebody might recognize CFPB. That was from the Dodd-Frank Act that basically said, hey, we don't regulate these guys enough between HUD and FTC and SEC and the FBI and the FinCET, and they had to add another bureaucracy that they now call the CFPB. CFPB. So there you go. That was the sentence. That's all abbreviations. And One of them's a funny one. It's TRID, T-R-I-D, TRID. It's TILA and RESPA, which are two abbreviations, pushed into an abbreviation. I think that's the funniest thing. TRID is an abbreviation of two abbreviations.
Sounds like a CDO of a CDO.
You're right. So anyway, I hope you enjoyed the show. Please like, subscribe. Have a lot of fun doing this. If you have a topic, if you'd like to be a guest, reach out. Love to have a chance to work with you. If you're looking for a loan in Utah and Nevada, check out ryanbolton.com, and we'll see you on the next video.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear, the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender NMLS number 299717. This has been a production from a podcast studio.